morning, everybody. Hello, virtual family and friends. I'm glad y'all are here today with us for Master Builders' fourth forum, Aggressive Investments Equals Massive Income. If you've already heard me, I said fourth, which means there's three forums you may have already missed if you're joining us just today. So I encourage you to go back and watch those videos. You can watch them via Facebook or you can watch them on YouTube, either one, whichever fancies you. But we just want to thank you for joining us this morning. We hope you have your pen and paper ready. It's going to be a lot of information. I know you're curious about that title, but I'm just let y'all know it's about some stocks and some information about it. So if you're like me, you got to be aggressive in getting that information as well. But just like anything else, I just want to start us all off in prayer because God is ahead of everything. And I know if we dab in and tap into him, then all the aggressive income is coming our way as well. So Heavenly Father, we thank you for bringing us here this morning. We thank you for this day. We thank you for opening up our minds, oh God, so that we can hear what is knowledge that is brought from you to us, oh God, from these wise individuals on the call today. We thank you for their time and effort into the situation so that we can also be blessed with that information. Oh God, I hope that everybody on the call this morning taps in, oh God, and does the research themselves after hearing. We've done a lot of groundwork, oh God, but we hope that they go forth and do the research themselves and dive right into it, oh God. We thank you and we give you praise and all the glory and honor is yours. In Jesus' name. Enjoy, y'all.
Well, good morning, Master Builder, excuse me. My name is Shandy Boyd Smith, and I am the owner of Hall of Fame Health. I will be facilitating the core values this morning. It is our custom to recite these, and I'll ask if you would please repeat after me. Be punctual, be dependable, be excellent, be detailed, be passionate and motivated, be optimistic and positive, be hungry and studious, be supportive, be benevolent, and be ethical. For the sake of time, I will only focus on core value number 7, be hungry and studious. And hence the topic of today's forum, aggressive investment equals massive income. The topic of investing can be very intimidating, especially for those of us who didn't have a grandfather, a grandmother, mom, or dad to educate us on the markets, because historically, they didn't benefit from it, and they were never taught about what they were missing out on. Benjamin Franklin once said, an investment in knowledge pays the best interest. Over the years, we have lacked the opportunity to build wealth for many reasons, including lower incomes that leave less money to invest after paying bills. Also, some of us work jobs that don't offer retirement plans like a 401k. But we must really look at what investment means. To invest is a verb. That means to expend money with the expectation of achieving a profit or material result by putting it into financial plans, shares, or property, or by using it to develop a commercial venture. We learned growing up to fear anything that dealt with money, and it really shows that around about 30% or so of Black households have a retirement account compared to 60% or so of white households. And in order for us to close the wealth gap, investing must be key to building wealth. And it has never been easier. Thanks to the technology of smartphones and apps, we can now have access to the education of investing at the tip of our fingertips with a single tap on our phones. This is where being hungry and studious comes into play. We have got to go after the things that we were once fearful of. It doesn't have to be scary. We can't control what has happened in the past, generationally, but what we can do is to move forward and take action. The Bible tells us, in all thy getting, get understanding. Know why investing matters. Increase your earnings and be open to taking risks. You can do this by looking into a side hustle or starting your own business, as many of us have done here in Master Builders Academy. I hear you say that you can't increase your savings or your earnings. Well, I beg to differ. Most of us have openly received stimulus checks and payments for ourselves and our children. That is a significant amount to be put to better use, right? Than being spent on something that won't give back to you. Many years ago, when I started working for a big corporation, they brought us in to talk about investing into our 401k. I went into that meeting determined that I wasn't going to participate. But after the presentation, I ended up not only participating, but I got really hungry and contributed the max since they were matching. I left that company after 13 years and was in the process of really deciding what I was going to do with that 401k to find out that I had almost $90,000 invested. Not $9,000 or $9, but $90,000 invested. Listen, I'm not perfect. I still have a long way to go. But after seeing the results of that investment, it makes me much more hungry to continue to learn and diversify what I now have as I've moved those funds into an IRA. Again, it doesn't have to be scary. We can all do it. We fear what we don't know. So I encourage you to be positive and optimistic about investing and understanding the best investment you can make is an investment in yourself. The more you learn, the more you'll earn, says Warren Buffett. And at this time, I'd like to turn the remainder of the forum over into the hands of our facilitator, our president, Michael Ford Jr. Please receive him and thank you.
Awesome job, Shandy. Thank you so much. Thank you, Keisha. Listen to me. I want everybody right now, go ahead. If you're on Facebook, hit the share button. Go ahead right now. If you are on YouTube, go ahead and send that out. Subscribe. Listen, I know we've been talking about real estate for the past month. And so many of you have dove in and gotten started in some capacity in the area of real estate. But listen, Master Builders Academy, we not trying to half step for nothing. We want to make sure that you get all the information. We want to make sure that you have an opportunity to reach every single goal, every single dream that you desire. Listen to me, somebody. I'm telling you today, if you haven't already said, well, they're going to talk about stocks. I don't know nothing about them stocks. I heard that's risky. I heard that. Listen to me, calm down for 1 second. What we're trying to do for you is to move you from being scared to move into where you are knowledgeable, right? We want you to get to a place where you get an understanding. So that's what we've created for you today. We've created an opportunity for you to get an understanding. But I'm going to tell you something. We're going to hit you with so much information. So you need to get your pen out. You need to get your pad out. And you need to get ready to just receive it. And then in the end, we're going to have the after party where everybody that you have talked to and heard on this particular broadcast today, you'll be able to get to go in and ask them further questions. So get ready for the after party. Those that are registered, those that are members, you know you have access. That's what we call the VIP after party. And I'm going to tell you something. I love what Shandy has said. Shandy, listen, she was real transparent. She said, listen, I went into this. I didn't think I wanted to do it. But listen, when she came out of it, she was $90,000 stronger. Now, I hope nobody sneezing at $90,000. How many of you, if you would just put your hand up in the chat and said I could use an extra 90,000? All right? I'm telling you, this thing can be very explosive for you. So today, we're talking about aggressive investment equals massive income. And I'm telling you, we're going to move you from being scared. Sometimes you're afraid because you just don't know. And I'm going to tell you something else. Stop listening to the people that don't have nothing. All right. I heard they said, listen, I heard and they said, you talking about the broke people. All right. Stop listening to broke people tell you about money. They don't know. All right. Today we're going to bring some people to you who actually know, who actually understand. And so the first person, listen, I couldn't do it without the vice president of Master Builders Academy, as John Mays, right? He's going to come first, and I want you just to receive him and get ready for a fantastic forum. John Amazing Mays.
Hey, what's going on, everybody? I hope we're doing all right. Guess what? Now is the time that we get an opportunity to go deep into a discussion that many people have been scared of for a very long time, including myself. We're going to talk about investing, but we're going to talk about it not in terms of the comfortable terms in real estate. It's something really sweet and cozy about real estate, especially to all of those who know people who own properties and know people who in the real estate game. I'm going to tell you, it is actually very easy and you can get very lazy doing it, but what I can tell you is that there is massive opportunity outside of real estate that many of us, including myself, have been very scared of. And what we're here to do today is to help you do the same thing that we are learning how to do, is to say that now is the time for aggressive investing. Now, when we think about real estate investing, we went through that for a whole month. Go back, rewind, look at those forums. There's money there. But now we're talking about stocks. We're going to get into that in a very deep way today. And hopefully you leave here today and not just leave like, oh, that was some good information. That was good. Oh, man, I like that, Master Builders. They get me pumped up. Don't tell us you pumped up. Don't tell us you love it. Go put some money on it. She said that she got 90,000 and she didn't even really realize where it came from. Guess what? That same thing happened to me. I'm working in the restaurant business. I was like assistant kitchen manager, and somebody said, one of the other cooks said, man, you got to just put a little bit of money away. You ain't gonna miss it. And so I started putting a little bit of money away. And before I knew it, by the time I left that job, I had like $10,000 in the bank and was able to use that money in order to seed into my own personal home purchase. But how do you even know to do that? Because somebody told you, but you took some action on it. So bare minimum, what we need to do from an investing standpoint is to put something in your 401k or retirement account through your job, through your check, because you ain't going to see it. You ain't going to miss it. But let me tell you the beauty, and I'm going to get into this part because Shandy really hit something special when she said she had that money up. Is your money in your retirement account can be accessed to do other things like that. She said 90, you can get a loan from that retirement account and buy a piece of real estate, and they can take the money from the loan off your 401k and they can come right off your check and you never even see it. So you can have income coming in from money that you don't even touch right now. And then it's going to be slowly taken out of your check. So I'm telling you, we have so much more than you think. And so oftentimes, if we look and dig, you can find money that you have access to and equity that you have access to that can help you to be able to expand. And now is the time to do it. And we're going to help through that piece. Now, if you go to my next slide here, oh man, this is time. And I don't want y'all to be salty when I go to the next slide, but some of y'all gonna be salty because nobody likes, and I told you so. But guess what? I'm gonna give you one right now. This is the only one I'm gonna give you all day. I told you so. And so last year, March 7th, and last year, March 21st, at the beginning of the pandemic, we yelled as loud as we could to stop what you're doing and start investing, because people are about to make millions and billions of dollars were being made in that moment. On March 24th, I believe, the stock market was at the all-time low for the last umpteen years. And you had an opportunity where we're saying, just get in the game, you can't miss. So guess what? I was scared to death to get in the game. I had let other people manage my money and do different things in a 401k. I didn't see it. It was just like, hey, I don't know anything about it. But I said, after these forums and we got done talking about investing, do you know what I did? I actually did it. I opened up an investment account. And so I took the money and I said, all right, I don't know this stuff. I don't understand it. I'm making good something in real estate. Why would I go and do this? All right, well, I'm going to put some money in there. All I'm regretting right now is that I didn't put in enough. I put in $6,000. And right now, every single thing that I invested in at least doubled. It actually more than doubled in some instances. Some stocks went up 4 or 5 times since then. And I said to myself, wow, if we would just do in a more aggressive way the things that we're saying to do, there's nothing stopping us from being wealthy other than our own discomfort. So in an effort to rehash last year with a good, hey, we told you so, is move out of your comfort zone. And now is the time to create passive income streams, specifically in stocks, because don't miss the next double up. Don't miss the next triple up. Don't miss your opportunity to be able to grow some wealth, not only for you, but for generations to come. And so let's go to the next slide. And so guess what, though? You're not alone. And now I'm talking to Black people. Black people, this is us. Check it out. This is from Black History Buff 2021. Just a screenshot of a screen here that says the net worth of a Black family on average in the United States of America is $17,150. Okay, stop right there. The net worth of a white family is $171,000. That is 10 times greater. 10 times. And this is the bad part, is that during COVID-19, the wealth inequality began to grow even stronger. Is that white families began to get richer and Black families actually got poorer. So there's now a larger gap. But there is good news in here, is that you personally don't have to be part of the gap. You can be on the good side of the gap by investing right now. Investing is saying, hey, I can do I believe you can. I believe I can do all of these different things. I believe my family can. And the way to it is as we get in a financial education, but we taking on some boldness to do things that most people have never done. I had to look back at my my grandparents and my parents and my grandfather. He recently passed away, and I love him and I miss him. And I look at his situation and I say, like, well, he was forced to have property in a certain area. The property didn't appreciate over time, but when he passed away, didn't have the property wasn't there for him to be able to pass to the next generation. And so the next generation basically had to start from scratch from a financial aspect. They didn't come with an inheritance. And then the next generation, what do they pass forward? And so, but there on the other side of this thing is, we need to pass forward a financial education and let the knowledge be what we can share as an inheritance. And then the money is going to accentuate the knowledge by allowing you and from generation to generation to know what to do with it. So go to the next slide. So this is part of the education that we're going to get today. So job just over broke. Oh man, somebody told me this a couple years ago and it really resonated with me. I don't know if Troy Teller's watching right now, but I really appreciate him sharing that, because I had to take this gut punch and it was like, hey, is if you work in a job, it's actually designed to pay you just enough so that you can pay your bills, but you still need your next check. And so in order for us to be able to get out of the rat race, out of the cycle of going from check to check or check to Friday or check to Saturday, somebody, y'all know what I'm talking about, check to Monday at 2:00, it's like, is in order to get out of that cycle, we're going to need to invest and pay ourselves first. Many of us are givers. If you're a giver, give first and give big. After that, give to yourself. as an investment. Investing in stock, investing in real estate. Don't let your money sit in the savings account anymore. If you sit in there in the savings account, it's waiting for you to spend it. But if you put it in an investment account, you'll be able to get a return on your money, and you actually going to be mentally less likely to touch that money. And so you can put things away, let it grow, and then don't touch it. And so many of us, are, and okay, I'm about to say something right now. Oh, I know somebody ain't gonna like this, but this is the real thing. And I had to deal with this, and I want you all to think about this, that it is a shame to live rich when you should be wealthy. And it's a shame to live rich when you should be wealthy. And so the issue is, like, many of us, get a job, and we making $15, $20 an hour, making $25 an hour, and we done made it. We got a house, we got a little something, we got money coming in. Don't let all our bills go out on auto draft. We go on a vacation every once in a while. We got a nice newer car. We pay the insurance, so make all our payments on time. And then all of a sudden, we made it. We are rich at that point. At that point, all of our individual needs are met, and we have no worry in our head about being able to pay our bills regularly, and we settle for that. And so what we need to do is to make sure that we aren't settling for rich, or being the rich uncle, or being the rich aunt, the one who people can come to borrow a couple dollars if they short. There's more to it than that. And so creating passive income streams is the recipe to build wealth, when your money is working for you and you aren't working for money. So when we working on a job, if we don't work during those times that we're supposed to work, we don't get paid. So our time, we're trading our time for a return that they pay us in dollars or pay us in benefits. That is not going to be enough to get us to a place of wealth. And that's what we want to do. Let's go to the next slide right here. Oh man, we got some really good stuff. And we got to keep it going, because I want to register it to you, because now's the time. If we listened last year at this time, you would have doubled your net worth. But we didn't listen. I got to tell you, I've doubled my net worth since last year, personally, just because from taking some action, scared action. And so I'm asking you right now to take some scared action after you get done with this forum. Take that just step into something that you may not have felt comfortable with, and do it, and don't be scared. And then as you build up your muscle of investing and doing it scared, you're going to find that you have massive opportunity, massive potential, and that your money is going to be doing some massive growth. All right, so let's look at Warren Buffett. He's like a very rich person. Actually, like, he's super wealthy. What does he say? He says, don't put all your eggs in one basket. Oh, that's good. What that's saying is, don't depend on one source of income. And so multiple streams of income. If something dries up on your job, well, guess what? You got a stock account. You got some real estate. You got a side business over here. You've invested with some other folks, and your money is working with you in their business. All right. The most important investment you can make is in yourself. Right now, you are making an investment. This is a huge investment, investing in knowledge. And guess what? That can never be taken from you. Guess what? Just because you doesn't invest in something, you might actually lose some money. But what you can't lose is the knowledge that you gain. And once your mind is free, it can't ever be caged again. And so the most beautiful thing about a financial education and learning that your money can work on your behalf is that your mind is free. It's going to make you a much better employee. I guarantee you, when you're not thinking about, your next check paying your bills so you can go to the grocery store and stuff, when you have an education where you could be able to support yourself, or find ways to be able to bring in income from multiple sources, you're going to say things at your job and let your ideas flourish. You're going to be able to speak up instead of being quiet. You're not going to be afraid to push back on your supervisor and tell them, hey, this ain't the right way to go. This is a better approach, because you're going to be bold enough to take action when most people are thinking, oh, I don't want to mess my money up. When you think, hey, my money's already right, it's always going to be right. There's an abundance out here, and it's going to make you better than you've ever been on the job. You're going to get promoted by getting a financial education. That's what I'm telling you right now. By getting a financial education and taking action now, you're going to get promoted. And how do I know? Because I'm living proof. And so that is a guarantee statement. If it doesn't happen for you, come back a year from now and I give you a full refund for this forum. Let's go to the next slide. All right. So 5 myths of investing. All right, so this is from Dr. Boyce Watkins, who joined us at our Hope Forum last year. And so I want to re-hit this right here because I love Dr. Boyce Watkins because he has the Black Business School, and there's a cost to it, but I guarantee you it's worth every nickel because the best investment you can make is in yourself and education. And if you want to know, you can know, and sometimes you can get free education, plenty of it on YouTube, or you can pay a little bit and get a defined track, from somebody with a proven track record to help him. But these are 5 myths of investing that I want to hit you on so that we don't fall into the trap. You have to be rich to be an investor. That is so false. Oh my goodness, that is false. We know through Robinhood, Webull, there's all kind of different things that Dejan McCarley is going to hit you with on how you can be an investor no matter what kind of money you got. You can have $5-10 and get in the game. Okay, so you can only invest money. That's not true. You can invest your time, your good name, your resources. You have so much more than you think. And you have to be an expert in order to invest. And that's what we're telling you is just take a scared action. And so you don't have to be an expert, but you do want to make sure that you are doing some hungry and studious research. And that's what we are teaching through our core values here at Master Builder Academy. And so it's all about fast money. That is a myth. You get wealthy slowly. You can say get rich quick. Yeah, you can get rich. And you can get poor. I mean, you can get broke real quick that same way. And so, but at the same time, there is ways where you can invest and get a return quickly. But to be wealthy, you're going to need that return to continue working and working over time. And the path to wealth is not a straight line. There's going to be some ups and downs. So you can't look at your little stock every day. Oh, I lost $1,000. Oh, I lost 500. No, you didn't. You don't lose it till you sell it. And if you think about it, over time, you have to understand the market will go up. And so you will make money every time. You won't make money every time. That's the best part about investing. There's some risk involved. So most people are scared of it. And like we say at Master Builder Academy, whenever other people are scared, that's when the time where the people who aren't scared get very, very wealthy. All right, go to the next slide. Oh man, it's some good stuff today. All right, so 4 millionaire asset classes. Y'all go ahead and write this down. All right, stocks. We're going to talk about that more today. Bonds, a little bit less risky. It's like giving a loan to an institution or giving a loan to the government. All right, of your money, and then they pay you back a little bit over time. More secure, less return. Real estate. Oh, we hit that hard the last month. Go back and watch that. Commodities, like people invest in gold, silver, oil, corn, etc. Diversify your asset classes that you invest in, and that is going to make sure that you have a return coming to you in multiple different ways. In case something dries up for a little while, you have it going in different areas. And of course, you can continue to grow your business and be able to invest in that. All right, let's go to the next slide. I'm going to leave you at one thing, because these are a few of the people who I've found in a few of the programs that I personally have been able to connect with, and on the next slide, that have been able to help me to be able to get a financial education, because the way that they're sharing it is a way that resonates with the way that I learned. And so everybody has different folks. I'm not saying these are the only folks, but these folks speak my language. I grew up in a 98% Black community within a hip hop culture environment, and so these people speak the language that I understand. And so this is a couple of them. Earn Your Leisure. Check that out. There's some good stuff on Earn Your Leisure. It talks about all kinds of different things. Check it out. It's free. It's on YouTube. Of course, they have some paid stuff too, but it's free. It's on YouTube. One of my favorites in the stocks is the Wealthy Investor Trade School. His name is Tyrone, Tyrone Jackson. Tyrone Jackson. Tyrone Jackson on YouTube right now has about 157 videos that show you from the last 5 years how to invest. And what you'll laugh at is when you go back to his videos from 2016, everything he said to invest in now has doubled, tripled, quadrupled in value. Every single one of them, if you just look at that. And so that can teach you how to become a wealthy investor with different strategies and different tools. And he tells it to you in a way that's very easy to understand. The other one is Bigger Pockets. I don't know if you all watch Bigger Pockets, but it's like podcasts. You can listen to it if you like to take a run. Sometimes I listen to a Bigger Pockets podcast and educate myself as I'm running. And then the other time is the Black Business School. That is Dr. Boyce Watkins, famous finance professor, economic freedom writer. And he has a great program. My personal self and my children are going through this program. And so that program, I think, is like $79 a month. But, once again, financial education for your children is the inheritance. And if they get some money to go with it, that's cool. But if they got a financial education, that is really the inheritance, the best inheritance that you can give them, because they're not going to learn it anywhere else, especially in schools. So with that being said, you can take the slides down, because now you're in for a real treat. And I know I just got you a little somewhere. So hopefully you leave there with some tools, but hopefully you leave with a challenge to every single person. If you don't have an investment account, go get one. Don't do it tomorrow. Do it today. And if you haven't invested, just do it afraid and jump into the game. But the next person that we have is a dynamic speaker, but at the same time, he is a young brother who's doing big things. He's a recent college graduate, but he is not new to the stock game and not new to the game of entrepreneurship and the game of massive hustle. Who we have coming up is a friend to Master Builder Academy, a true lover of people, and he's also one of my favorite young businessmen, Mr. Dejan McCarley.
Thank you all for having me today. Today, I'm going to teach you all how to make money in stocks, and I'm going to just cover the complete basics for anybody who has never invested or don't know where to start or don't know how. I'm self-taught. I picked it up during COVID, and I've learned everything I know now, and I've invested my money, and I've made double my money in the stock market just by picking up and going and doing. You can always learn stuff on the internet, but I'm going to cover the basics with you all today. And as you see here on my PowerPoint, it says how to make money in stocks, if y'all want to go on to the next slide. So on today's agenda, as you can see, we're going over how does the stock market work? How do you get started if you don't know where to start? What to look for, the basics on investing and the power of investing. At the end, I'm gonna tell you a little story myself about, what happened with me at the end. So stay tuned, and it's a nice treat for you if y'all want to go on to the next slide for me. So the Dutch East Indian Company, how does the stock market work? The Dutch East Indian Company in the 1600s, the Dutch East Indian Company deployed ships to trade goods in certain parts of the world, and it wasn't a cheap voyage. So in order to fund it, they had turned to private citizens, and that's essentially all of this is how the stock market works today as well. People who invested money to support the trip in exchange for a share of the ship's profits. So the Dutch East Indian Company had all these goods that they wanted to trade. They wanted to reach a new audience and trade, but they couldn't afford to pay it out their own pocket. So they went to people and sold shares of the voyages to private investors. They then went out and sold these goods and brought back the profits, and they split it with not only the people they showed the shares with, but they put their own money in their own pockets as well. And on top of that, they were able to expand and go explore different parts of the globe. Not only were they confined to, you know, certain parts of the world, after getting investors on, they were able to grow their business and explore different parts of the world. And that's how the stock market kind of works today. Unknowingly, they invented the world's first stock market, the Dutch East Indian Company. And with that, you know, being an investor, my next point, you're the investors. When you buy a stock, you become partial owners. So you can walk around here, if you buy a share of Apple, you could walk around here and say, hey, I own part of Apple, because technically you do. You become partial owner. You help the company grow when you do that. And once you buy in, as demand for those stocks increases, so does the price of the stock, and the cost for the prospective buyer. So if I buy a stock at $10, and other people see the value in the stock, and the stock begins to rise, they buy in, I can sell it at $15-$20. It's a supply and demand thing. If the demand's high, the price of the stock will go up. But also in that, there are risks, which is my next point. If investors think the stock value is going to decline, they will sell with hopes of making a profit before the company loses more value. So when you invest in stocks, you have to pay attention to what's going on, not only in the company, but in the world. And a good example of that is Papa John's. I know when Colin Kaepernick thing and the whole NFL, when they were taking knees, the CEO of Papa John's said something against that, and the stock plummeted because people got scared that people were going to retaliate. So they started to sell off the stocks. And if you're not aware or paying attention, you might lose money. Same with Wells Fargo CEO. He said something along the lines of, the reason why there isn't diversity in Wells Fargo is because there aren't people that look like me who are qualified for the positions. As a CEO, that's something you shouldn't say, especially to the public, which it hurt their stock as well. Same with, government moves, presidency moves. When Donald Trump was in office, he put tariffs on imports and exports, and that hurt certain industries. So things like that you have to pay attention to. And in some of these trading apps, they will give you the news feed on how these, what's going on around these industries, which is in my next slide if you want to go on to the next slide. How do I get started? The first step is choosing a brokerage, and it really doesn't matter what brokerage you choose. Most people use an app so you can check investments whenever you want. Webull and Robinhood are the most two popular apps that people use, in the market, because you can get them in the marketplace and you can essentially check them at any point in the day. But they will ask you personal questions, and you do have to be 18. Once you answer these questions, though, they'll review your application, and it usually takes 1 to 2 days. After they review your application, you are free to buy, sell, trade whenever. My personal favorite is Robinhood because it's a lot easier starting out to navigate. Webull's, if you're not familiar with everything, Webull's a little bit more complex, just a tad. But either one you can go with, and I'll put the code in there because when you join Robinhood, they give you free money. They give you a stock that you can buy, sell, and trade. You can do whatever you please with it. So if you don't know anybody that's on there, you can use that. And once you get in, you can send your code to people because they'll give you free money. That's free money on the table that you can have. You're welcome for coming to Master Builders today. So the next point is, do I need a broker? Now, I'm not going to tell you. You don't need one, or you do need one. But everything a broker does, you can do too. You can do at the palm of your fingertips. Now, with a broker, you'll pay commission in some of your money. So he'll make you money, but he'll take some too, or she. But, if you just want to give it to them and not have to deal with it, you don't know what's going on with your money, then by all means, you can do that. But everything they do, you can do at the palm of your hand as well. You go on to my next slide, please. So I'm going to give you, this is the Robinhood app. I'm going to go over a couple things, what to look for in the Robinhood app. This is what I look for before I do buy a stock. And I'll tell you what each one is. The first one is earnings. That's earnings per share. That's basically what are companies are projected to do versus what they actually do. Earnings per share is a company's net profit divided by the number of common shares it has outstanding. A high earnings per share indicates that a company is more profitable and has more profits to distribute out to their shareholders. So if you, this is a real company I took a screenshot of, and as you can see, their earnings per share on the far right is negative. So that means they're not making any money right now. But also, if you look in the stats in the bottom two right, the PE ratio and the dividend yields, this is not a dividend stock. And I'll get more into that later. This is strictly an investment stock. This company specifically is focused on growing and being profitable. Then once it becomes profitable, then they'll pay out dividends to shareholders. But I'll get to that later. So I look at the earnings per share, depending on what the company's doing. This is strictly an investment stock. I pay attention to that, and as you can see, some are gray or lighter than the others, which means that's what they were expected to make. The darker ones are what they actually did, and it's made up of all the past 5 fiscal years, and we just starting out. So this one goes all the way back to 2019. But I pay attention to this for sure before I decide on if I'll buy a stock or not. This next one, the bottom one that says the analyst's ratings, that in my opinion, that's what I look at as well. So as you can see, 15 analysts, they analyzed this stock. They did the math for you. They did the numbers for you to determine if this is a good buy or not already. 80% of those 15 said it's a good buy. I already own this stock, and I've made a great return on it, and I've already bought it. But it also, you see that these two, the earnings and the 15 analysts rating is in red, which means the stock is on a downward curve right now, which is also a great time to buy. But this is also something that I pay attention to in the Robinhood app, because they already do the work for you pretty much. Now, I wouldn't solely focus or base my decision off that alone. I myself play into that. To buy, of course, means to buy the stock. Hold means you stay where you at, don't buy or sell any. And then sales, of course, just sell off your stock and make your money. Now, they already do the PE ratio and the dividend yields, the math you need in order to figure out, if it is a good buy. So that's why I pay attention to the analysis rating. And I'll tell you some of what the stats mean. So this first one, open. So open is what it opened at on that trading day. So when you go into the app, what app you choose, when you go into the app, they'll give you these screens, and you want to pay attention to these numbers. High is the highest it's been for that trading day, and the low is the lowest it's ever got on that specific trading day. And the 52-week high is the highest it's ever been in the past year to date. So March 6th of this year to March 6th of last year, the highest this specific stock has ever been is $75.49. I pay attention to the 52-week high as well, because I want to know what the possibilities it has to do, and how long ago did this stock reach the 52-week high. So I pay attention to that. The 52-week low is the exact same thing. The lowest it's ever been between March 6th of this year and March 6th of last year. The volume one, the 49, almost 50 million, is the number of shares sold or traded in a time frame, usually the day, as well as the average volume. Average volume is the number of shares that are traded in a day, and the volume number are number of shares traded over a period of time. Market cap is what the company is worth. This company is worth $20 billion. Apple worth $1 trillion. Amazon worth $1 trillion as well. And the PE ratio and the dividend yield is what I was telling you about earlier. The PE ratio is the ratio for evaluating a company that measures its current shares price relative to the earnings per share. The PE ratio is the math that I told you that the analysts do for you. And starting out, I wouldn't worry about that. I will focus on strictly, investment stocks, companies that are just focused on growing. The dividend yield portion is what companies pay out to their shareholders. And I'll get more into that on the next slide, if you all want to go on to the next slide for me. So the basics on investing. It's easy. I'm telling you, it's Jackson 5 put it best. It's easy as ABC. I'm telling you, all it takes is for you to hit the web, do what you got to do to learn, which is why you are here. We're going to teach you as much as we can, but you got to put forth that effort and go out there and just do it. You got to just start out. There are 2 ways to make money by investing. Stock appreciation. Those are the stocks I was telling you about that are strictly focused on growing their business. A stock you own goes up in value. You buy a stock at one price and the price goes up. You, the investor, could then make money by selling the stock at a higher price. So all you do is buy low, sell high. That's my next point. And also, John mentioned that earlier. You want to pay attention to stocks in the red. There's no reason why anybody should be paying attention to stocks in the green unless you own it, because we want to buy stocks that are on the downward curve and are on their way up. So that way we can buy as many we can in the red, and once it gets up, we sell everything and do it again. Repeat the trend. That's how you make money. There are also another ways to make money by investing in the stock market is dividend stocks, which is what I was talking about. It's a periodic payment issue by some stocks. Like I said, not every company, they pay out dividends. Companies give out a portion of earnings to its shareholders. So it depends. It can range from the fiscal quarter to annually, which is once a year. And depending on how many shares you own, they'll pay you for being a part owner in the company. So if a company makes money, Microsoft makes money, and they don't have anything to do with it, they don't need to invest it, they don't need it for anything, they'll give it to their shareholders. And if you own enough shares, you can make a nice amount of money just by being a shareholder. And it goes into my next point. You got to diversify your portfolio. Also, something John talked about. You got to diversify your portfolio. You don't want all your eggs in one basket. When you in the stock market and you are investing, you want to be into many different industries. Imagine if somebody was still invested in the coal industry to this day. They would have lost all their money because it's not as booming as it was maybe 20 years ago. You got to diversify your portfolio, because if something happens in one industry, it affects everybody and you could potentially lose big. So you got to have your money in different industries, but invest in things you understand. Don't go and put your money in something that you're not knowledgeable about, but you can also find that same knowledge online. Last point, and Warren Buffett as well talked about this: when you see a great opportunity, you take it. And that goes into my next slide as well. You want to go to the next slide. When you see a great opportunity, you take it. So as you can see here, this is a part of my own personal portfolio, this specific stock. This is also the power of investing, and when you see a great opportunity, you take it. So as you can look here, as you look at the average cost, it says the average cost of this specific stock was $15 when I got it. $15. Now, I was at that time, the stimulus checks just hit. And I was out here doing frivolous spending, putting my money in places that wasn't making a return on my investment. And that's the difference between the rich, the middle class, and the poor. The rich see money as employees. Those employees go out and make money for them. Money is employees. People see money and think, more money means greater expenses. No, more money means more employees to go and make me more money. And that stimulus check, I didn't have this mindset at that time. The stimulus check, I went and blew it. I went and spent it on stupid stuff. And this specific stock, I knew it was going to be big. I knew it was going to be in something big. And I'm in an investment group, and I told all people in my investment group, hey, you need to get into this. This is going to blow one day. This is going to be big. So I told them this, and I went and did the complete opposite. If I would have took my stimulus check and just put it all in there in this one stock, you see average cost $15. Today is valued at almost $72. And I bought one because I was like, let me just go ahead and get one. And if something happens, I got one at least. Let me go ahead and buy one. And I did that. I bought one and didn't think none of it. I didn't pay attention to this specific stock ever again. And it ended up blowing up. And if you hit the space bar for me, controller, if I would have if I would have went ahead and took my stimulus check and bought this one stock, put it all in there, I would have made $7,000 just like that. $7,000 I would have had, and I could have repeated that cycle. I could have took that 7, did my research, did my due diligence, and went and did the research and found another stock just like that I knew was going to be successful, and put that 7,000 in there, and the 7 would have turned into 30. Did it again, 30 would have turned into potentially 6 figures, and so on and so on. So we have to do our due diligence. We getting another stimulus check. I ain't got the second one, and they just approve a third one. So there's still an opportunity to be able to do this. And don't be like me. Use my example and my pitfalls. My life could have been changed already. Don't be like me. Don't go out there and spend your money on stuff that's not going to make a return on your investment. But I appreciate y'all for having me. Just do it. Just go out there and just invest. Start the account. And if you have any questions, I'm here to help all the way.
Wow. Okay. Now, you just heard from Dejan. Now, hopefully you are inspired now from the speakers that have spoken up to this point, that there's so much opportunity. Dejan said a couple things that really stuck out to me. And one of them was that we need to get in the game. I love how he talked about, hey, this is what I could have made if I'd have done it. But guess what I'm proud of is at least he got one, and so now it's time for you to get your one. But this time we saying do it aggressively. Instead of just putting your toe in with one, is he said, well, what if I'd have put more in and stayed away from some of the frivolous spending? He did a fantastic job of showing you some of the easy things that you can do to be able to get started. Robinhood, Webull, and then some basic looks. Sometimes we see all these charts and all these different things. It can get so confusing, but he showed you some simple practices that allowed him to be able to make some good choices with his early investments. So well done, Dejan. Matter of fact, Dejan, holler at me. Let's open up a business. I'm serious about that. All right. So next up is Don Hardison. Now, if you don't know Don Hardison, you don't really know nobody, because this brother knows money. Like when I first was starting to think about investing and I was just sitting there dipping my toe around things, I met Don. And I would tell you, not only is he a good father, not only is he a powerful man in the community, but he's also very knowledgeable and has a financial education. And he can teach us things and give us a perspective that's going to change our opinion on some of the paths to be able to get to some long-term wealth. And it is with a great pleasure that we welcome a man among men and a friend of Master Builder Academy in a huge way, Mr. Don Hardison.
Up to that introduction, but I appreciate it. So thank you very much. And awesome job by Dejan ahead of me. He laid down some good stuff. So I'm always excited when I see young people excited about getting in the market. So I'm an old head now, so I really appreciate that. So my advice to him would be keep going, learn as much as you can, and if I could be of service to anybody, feel free to reach out to me. So I am going to talk a little bit about, for those that don't know me, I mean, people know me as Don, most of you know me as Donnie. So I work as an investment advisor, okay? And I'm a senior portfolio advisor for a company here in town. So I've been in the industry for about 15 years as a licensed professional. So there's a construct that I want to give, and then we'll take a deep dive into some details. But the construct that I want to give is I want you guys to write this down. Actually, it's going to be 4 things I want you to write down. The first thing is called MPT. M as in modern, P is in portfolio, and T is in theory. Okay, I want you to write that down. We'll come back to it. Okay, and then the second thing I want you to write down is CA. Okay, I'm sorry, CMA. I'm sorry, CMA. So that stands for capital market assumptions. Okay. And then there's one more thing I want you to write down. That's EF, and that stands for efficient frontier. And then I lied. There's one other thing I want you to write down, and that's fiduciary. It's FIDI. I'm sorry, FIDUCIARY. Okay. So that provides the construct from which we're going to operate right now. So I'm going to talk about once you have that portfolio established, right? The main thing that you want to be mindful of is risk, right? So when I'm putting together portfolios for my clients, the first thing I think about is risk. The second thing is risk. The third thing is risk. The fourth thing is risk, right? So the hard and fast rule, the general rule is we want to go up and participate in the upside of the market when the market goes up. And then when the market goes down, we want to be down by less. It's inevitable. The market is cyclical. You got to know when to pick your shots, right? So like Dejan kind of said ahead of me, buying in the red is a good strategy, right? But you also want to make sure that you're not missing out on some of the green shoots that have already happened, but still have more runway. So there's 100 ways to skin a cat, but that's just first starting off laying out the construct. So what I want to talk about is I'll talk about a little bit regarding what the coronavirus has done in terms of providing opportunities out there in the market and the volatility that we've enjoyed or endured over the past, let's call it 2 weeks in particular. We'll also talk about alternative investments in detail, and then we'll talk a little bit about some practical applications and ideas that we can utilize. All right. So as it relates to what's happening in the market as far as the coronavirus is concerned, we've had this pandemic for over a year now. We've lost a lot of people. I think the number got up to 500,000 for the U.S. just in this past year. So it is tough times for a lot of people, but there's a lot of opportunity, like Dejan said, out in the market to do some great things, to do some investments, to plan for the future, to blaze a trail towards what you want to do and accomplish for you and your family. So keep that in the forefront of your mind. And the other great thing, well, the other positive thing that the coronavirus has done, it has forced all of us to really look at our health and well-being and take it a lot more serious than maybe we've done previously. And then finally, the uncertainty in the market again creates opportunity for us to move forward and advance. So if we could skip to the next slide. So as we look at it, right? So given the backdrop, what's happening? So the Fed Reserve has kind of enacted some stimulus measures. We saw the market, the interest rates not go up and be held steady a couple of times. And then we saw the Fed Reserve chairman come out and say, hey, I'm going to do whatever it takes to make sure that we keep inflation at bay. And then subsequently, we saw the 10-year Treasury move 60 basis points over the past week or so. I know there's a lot of information, but it's all useful. And I'll tell you why it's useful. As interest rates increase, typically the stock market experiences volatility. The stock market and prices of stock usually go down as interest rates increase. Why is that? Okay, it's usually the growth stock, because the growth stock are the alternative to more stable stock, right? So that's where the hot money goes, right? So when there's no other alternative, meaning the safe money in bonds is not available, if you're not getting more than 1% a return on a bond, you're not going to invest in that bond. You're going to look elsewhere. You may as well put it in a stock, because at 1%, you're not outpacing inflation that moves at 2%. So inflation is another term that we should talk about. So inflation is the value of your money that decreases. It happens on an annual basis. So the going inflation rate is about 2% right now. That means for every $100 you have in the bank, you're really, when you go to spend it, you're really only getting $98 out of value from that $100. So that's just an example of inflation. So these are the things we want to keep keep in mind as we build a portfolio and we look to invest and we're looking at returns and we're looking at risk. We want to keep all these things in perspective. Okay. If you skip to the next slide for me. So this is another thing that's very important, and this is what we have to make sure that we keep front of mind, right? Don't abandon the markets, right? We saw a tremendous amount of volatility, and again, like Dejan said, there is tons of opportunity out there, right? Even if your stock or your portfolio is down a couple of $1,000s right now, it is not the time to sell when you're down. It's not the time to sell when you're down. You sell when you're up. Okay. I know that seems kind of converse to what we're thinking, but you have to stay in the markets and ride the wave. And I'll have another slide that comes up here shortly that shows the cyclical nature of the market and what you can do during those times. And then secondly, remember exactly why you're investing. What is your goal, right? What is the purpose of your investments? I think Shandy talked earlier about she invested in her IRA, and John kind of reiterated that as well. She invested in her 401k at work, and then she rolled it over into her IRA when she separated service. Well, that money is earmarked for retirement, right? And what we want to do is we want to build a consistent portfolio so when we're in retirement, we don't have to eat cat food or work as a greeter at Walmart unless we want to, right? So we want to make sure that we can provide a portfolio that provides a consistent level of income during the retirement years so we don't have to worry about things like inflation or cash flow. We already got that set out, and it's what we would call mailbox money. You just go to the mailbox or go look online and get an ACH check deposited right into your account to take care of the things that you need to do. And that money offers you freedom, flexibility, and more opportunities as you enter into the golden gem sort of era of your life. Okay. And then third, remember the basics, right? Like Dejan said, you want to buy low and sell high, right? You want to stay consistent and remember it's all about mitigating the risk and increasing your opportunity or the potential to grow. So again, fourth thing is looking for opportunities out there in the market, right? And so how do we do that? Let's jump to the next slide. Okay. So specifically, what I'm going to talk about is alternative investments, right? So alternative investments is considered a very aggressive form of investments, right? So you should only consider alternative investments when you already have an established portfolio, right? Because of the risky nature inherent in alternative investments. And this goes back to one of the first words that I gave you at the beginning, fiduciary. So I'm a fiduciary for my clients. What does that mean exactly? It means when clients come to me and they bring me their retirement money or they bring me their kids' college savings or whatever, they bring me their taxable money, they entrust me to invest with their best interests at heart. That means I'm not, putting it all on black and and hoping that the lucky number 7 hits. No, I'm not taking those chances. The reason why is modern portfolio theory tells us that if we invest in a portfolio that has a diverse allocation, right, a diversified approach, that means that we have stocks, bonds, alternative commodities, private equities, hedge funds. We have a mix of those things. And those alternatives should not be more than 10 to 15% of the overall value of the portfolio, right? There's an important reason why that's there, right? It's there for a fail-safe as a buffer to help in the downturns of a market. Okay, so we'll stay on this slide, but I just want to read to you exactly what the definition for a hedge fund is, because there's a lot of different takes on that. So I want to read the textbook definition for a hedge fund. Colloquially, we know a hedge fund as a fund that hedges bets against one thing or another, right? And what does that hedge actually mean? That means that if I have $100, I borrow another $400 from someone, and then I make a bet or I make an investment using $500 instead of the $100 that I got. And if I make back money on that initial $500, then I get to pay back the person that loaned me that money, and I use their money to put our money collectively at risk. That's hedging. That's hedging your bets. So the definition is hedge funds are a strategy that engages in a wide range of investments and trading techniques not available in traditional asset managers, such as investing in liquid markets, taking on concentrations, and using leveraged derivatives and short selling to help generate returns. Adding hedge funds to a portfolio can assist with capital preservation and provide you with differentiated returns, So that gives you, and there's tons of hedge funds out there. There's all kind of different bells and whistles on them. But you should do some investigation and figuring out, talking to a professional, figuring out which one is going to be the best for your particular situation. And then private equity. What is a private equity, right? So private equities are just like it sounds. It is shares in a stock of a private company. Well, how do we get that? Right? How can I buy into shares of a private company? Well, you can do it on an individual basis. Let's say, for instance, we most frequently see this with law firms, right? And let's say Frost Brown Todd, for example. They're a private company, right? But you can go and potentially, if you're an accredited investor, purchase stock in that private company, right? And that company's performance gets evaluated at the end of every year, and they get audited, and they determine, okay, one share of Frost Brown Todd is actually worth $300 this year as opposed to $100 last year, or whatever the number is, right? And then you, as a shareholder of a private equity, share in that appreciation of that particular private stock. So it is a real good tool. It is tough to get into because there's a couple of levels of barriers there and accreditation that you got to go through, but it's not impossible. All right. And then the last one is real assets. And most of us know what this is. This is your land, real estate, gold, commodities, silver, all those sort of things. Those are real tangible assets that you can invest in. Okay. So that just gives you, that just kind of sets the stage for the alternative investments and what is actually available out there. So let's click to the next slide. All right, perfect. So this gives you an idea of why a hedge fund is important. So the dark blue lines represent a period of time, and I think that first one is May 2011 through, oh gosh, I can't see that, September 2011. Okay, so that represents being down about 16 to 18%, right? The S&P 500 was down that much. But if you look at the hedge fund index, the hedge fund index was only down about 6 to 8% that year, right? Or during that time frame. So this is where it is important, right? So like I said at the onset, when the market is up, we want to participate in the upward trajectory of the upward movement. When the market is down, we want to be down by less, as simple as that. So our goal is to create a portfolio that allows you to enjoy just that, right? So putting a hedge fund as a part of your portfolio does that. It mitigates some of the risk, right? So when the market is down, you don't have to participate in all that downward motion, right? And if you have a balanced portfolio, you're not enjoying the full 18% of the downward movement as it happens anyway, because you're diversified. So you got 40 or so, or maybe 30% bonds in your portfolio as well. So you're kind of balancing, doing a balancing act there. So that's an example of hedge funds. Let's jump to the next slide. All right, so next slide just shows private equity, right? So private equity, we see the same thing. So private equity, and what we have is two very strong financial crises, right? The tech bubble, you'll see that happened in roughly 2001, 2003, around that area. And the market was down tremendously, but hedge funds were up almost 20 to almost 30% positively. And then same for the global financial crisis that happened in 2007, 2009, around that era. Hedge funds were up around that same time, right? 25, 26%. So again, This is a part of the portfolio that we use to be a buffer in down markets, right? And the upside that we get on in good markets, that's just icing on the cake. So we'll take that. That's gravy. We'll take that all day long. So let's jump to the next slide. All right, perfect. So these are common questions that I get all the time. Alternative investments, how does that make me? How does that help me? How can I generate a better yield? And by utilizing these particular alternative investments at the right time in the market could really help enhance the performance of a portfolio. So let's jump to the next. All right, perfect. So I alluded to this before. So this is the market, right? So during any market cycle, we're going to enjoy a full market cycle is going to go through these 4 stages, right? So you have the expansion phase, right? You have the peak of the expansion phase. That means boom, we hit the ceiling. There's nowhere to go but down, and then we begin that downward trajectory or contraction, right? And then we hit the bottom, right, which is referred to as the trough, right? We hit that bottom last year around this time. I think it was March 18th or so, when the market was down 35% year to date at that point. Right, that was a trough. That was the absolute bottom, and it teetered around a little bit around that area, and then it started to go back up. So from the trough of the market last year in March 18th, 2020, the market was down year to date 35% roughly. We finished the year, the market was up roughly 18%, 16 to 18%, depending on how you calculate it. So that just shows, the power of staying invested, right? And I do have clients that some of them got out at the bottom and said, I'm retired. I don't need this risk. I don't need this stress. I don't want to be in the market anymore. And so when we pulled them out of their portfolio, they had a 20 to 30% loss, right? And so how long does it take you to gain that back if you're out of the market, right? And you miss the upward trajectory as the market kind of returns and recovers. So you want to keep that in mind. So let's skip to the next one. All right, perfect. So there's 2 ways to go about adding hedge funds or alternative investments into your portfolio. You could take a diversified approach or diversified allocation, and you could use a multiple strategy, right, which has hedge funds, real assets, private equities, all wrapped up in one fund, right? You could do it that way, or you could take a targeted approach. Now, my personal opinion is taking the targeted approach makes more sense for individuals who are just building a portfolio. So what does that mean exactly? Okay, so that means if you got, $100,000 worth of investment assets in a portfolio, right? You got that going. It wouldn't hurt you to diversify and talk to John or talk to Mike or talk to Troy or somebody about getting involved in real estate, just to have some real estate as well, because it doesn't have to all be in the same account. Your life is your portfolio. You just want to make sure you have somebody that's looking at the totality of everything and showing you your blind spots, right? That's the importance of an advisor that can show you, okay, you're excellent in real estate. You got all this property. This is great. But how are you protected when the downturn in the real estate market happens, right? Because it's inevitable. Every market is cyclical, right? And then conversely, right, if I'm advising on your portfolio, I want to make sure you have assets outside of your portfolio as well to help when the portfolio is down. I want to make sure you have the most amount of passive income that you can have and have a diversified approach to your income. So that's the way I would do it. I would go about a target allocation first for those folks that are just getting started with portfolios and investing and the like. And then as we grow bigger and more sophisticated, then we'll have a diversified allocation to alternative investments. We could skip to the next slide. All right, perfect. Same information here. Just remember, your goals and your financial situation dictates how you should invest, right? We're not investing mortgage money. We're not investing rent money. We're not investing the baby's milk money. No, we're not doing that. We are being strategic. We're being smart, and we are being very, very intentional about how we invest, right? So let's skip to the next slide. All right, and same issue here. We just want to make sure that we're taking into account all the special situations and using hedging when necessary, but not overextending yourself and overexposing yourself to unnecessary risk. That's why the risk of a portfolio is important. And if you don't know what the risk is in your portfolio, then it doesn't take much for you to ask somebody to evaluate your portfolio and give you the risk. Most people will do it. Most people will do it free of charge. I do it all the time free of charge. So if you have any problems, any questions, feel free to reach out to me and I'll help you along the way. No problem. So let's skip to the next one. All right, perfect. So this shows you why quality investment and alternative investments matter, right? So what we have here is we have a view of what it looks like if you're invested in, and I'm having trouble seeing that. I'm getting old, so I need my glasses. So, but I'll tell you, I'm trying to read what the numbers say, and I'm having trouble. So, but the traditional equities, right? This shows you the bandwidth over the past, 20 to 40 years, what the bandwidth of return has been, right? So the top quartile or the top 25% is roughly at about 14% return, which is a good return over 20 plus years. That's a great return. The average is about 8% over that same time period, right? So on average, we're getting 8.8% return on traditional equities. It's perfect. That's great. And then the bottom quartile is about 2.7% over that same time period, right? So not as great, but it's still positive and it's still moving past the rate of inflation, right? So the next section, it looks at hedge funds. As you see a wider disparity between the winners and the losers, right? So the top quartile over that time period, the top quartile of hedge funds earning during that same time period is at 32.7%, right? That's almost 4 times what an average traditional in equity is doing. And then conversely, the bottom quartile shows about negative 13% return. So yeah, much risk, much reward, right? And then the average is right at about 5.2. And then looking at private equity, same sort of scenario as with traditional equities, we're looking at an average return of about 1.1, and then the top quartile is at 1.7, and then I'm sorry, 17, excuse me. I cannot see. It is average return is 13, I'm sorry, and then 17 for the top quartile, and then for the bottom quartile is 1.9 or 2%. So this is the importance of making sure you have more than just one approach to investing. Again, your life is the portfolio. You want to make sure that you're doing things inside and outside of your portfolio to build your entire life, because you're constructing what you want your future, your elder years to look like, and the future for your children and your children's children, and really the legacy that you're building. So it all starts with a solid foundation. And in my view, a solid foundation is a strong portfolio with things that and we can kind of guess the performance. And we just want to make sure that we can add to that, accent it, put gravy on top of it, put icing on top of it when need be, and make sure that we can withstand the long haul based on how we're investing. So let's skip to the next slide. All right, and we can skip to that next slide after this one, and skip one more. Boom. So this is what we should consider doing now, right? If you haven't done so already, you and your spouse should sit down and determine what are our goals, right? Or you alone could sit down and determine what is my goal, all right? And this becomes the reason why you stay invested during tough times, right? So when times are tough and the market is down 10%, you want to make sure that you realize, okay, my goal is to retire at 55, right? So in order to do that, I got to stay invested, right? Now, if you're 52, we want to tweak the investment a little bit to make sure that we're not putting too much of your retirement savings at risk at this point in your life, right? And then secondly, we want to make sure that we maintain a well diversified portfolio and have adequate liquidity. I can't stress this enough. So after we evaluate risk in a portfolio, as we're building a portfolio based on where a client is in their life, if they need income, we want to make sure that the portfolio that we generate or put together generates enough liquidity that we don't have to go in and cash out any of the investments, right? So it's important to have diversity. Okay. And then thirdly, we want to adjust or rebalance the portfolio to align with the goals, right? We want to make sure we align with any goals that we have. So if it's college education, if it's retiring early, if it's buying vacation homes, if it's buying more real estate opportunities, we want to make sure that we're investing to do those things. Okay. And then finally, work with an advisor or work with a partner, right? A lot of times we're so afraid to tell somebody what's going on with our investments or what we're doing from a business standpoint that we make unnecessary mistakes when we could just physically have a conversation or do it over the phone and say, hey, I got this investment, it's not doing good, or I'm thinking about doing this investment. What do you think? Right? So I do it all the time, right? So if I'm thinking about investing in real estate, I know who I'm calling. I'm not just going to rest on my own experience. Or if I'm thinking about investing a business, I know who I'm calling, right? I'm thinking about starting a business. I'm going to call and get advice and say, hey, this is what I'm thinking about doing. Is this a stupid idea? Am I not seeing something? But two or more heads is definitely better than one. So we always want to make sure that we're doing a lot of self-check. Again, develop a goal, stay invested, maintain a well diversified portfolio, readjust and rebalance as necessary to make sure you stay in line with your goals, and then work with somebody. It doesn't have to be a professional. It should be at some capacity, but you can work with somebody else that makes sense, that sees things the way that you see it. And conversely, you can work with somebody that sees something completely opposite. But you have to work with collaboration is key to success. No man is an island, no woman is an island. So collaborate as much as you can. And just know that we're here. I'm here. If you ever need any advice, any help, any questions, any problems, any concerns, I'm here. So if you want to skip to the next one, we can kind of open it up to questions. So
I told y'all. I told you. I said you in for a treat. And then what did you get? You got a treat. And so
thanks,
thank you so much, Donnie. I'm gonna tell you that was fantastic. You could probably take that slide down for right now. Go ahead and take that down. We got some Q&A for you. And so
Okay.
we had some questions that came in, but then and so we'll take it like that. And so, but like if somebody is scared and they've been scared in the past, to get into investing because they got a little money in a bank account put to the side and they use that as kind of a security blanket, but they wanted to get into investing, how would you what would you say to kind of ease their fears a little bit?
So I would say this. I think it's very important to have an emergency fund, right? Because we all know things happen, life happens. So the emergency fund should be anywhere from 2 to 3 times what your monthly expenses are, right? So outside of that, if you have that, rest assured, all right, if worst comes to worst, you lose your job, you got 2 months worth of expenses you can cover. The rest of the money you should be investing toward a goal, whether if it's investing in, buying into a stock or a stock idea or just buying an index. For most people that are just starting out, buying an index is a simple and easy way to get involved in the market. And you're not picking a particular stock. And I always say this, the fastest way to become wealthy is a single a concentrated equity position, right? The fastest way to not be wealthy is that single concentrated equity position, right? Because it's inevitable. What goes up must come down, right? So that would be my advice.
That's good. I really like that. I like the tip on the emergency fund, and that'll probably make you feel a little bit more at peace when you're making these investments, that it's not going to affect your grocery money, affect your
Absolutely.
rent money, affect your family's money. And so thank you. I think that was phenomenal advice. You also said something in that last slide area that really resonated with a couple folks here, but it's like it's like knowing what you want. And I think we talk about that a lot at Master Builder Academy and kind of getting a visualization. But at the same time, what are some examples? Because a lot of people don't know what they want because it haven't been exposed to different things. But what are some examples of some of the types of things that people have said, hey, this is what I'm shooting for?
Sure. I have a number of clients that, love what they do, and work in companies, corporations, or whatever. But they're like, I love this job, but I can only do it for about 5 to 10 more years. I got to get out of here, and they may be 40, 42 at the time, right? So retiring early seems to be a very, very popular goal. So if that's your goal, then know your number, right? So know how much money you need in retirement to feel comfortable. The general rule that I use and most financial professionals use is 60 to 80% of what you currently make in your salary should be what you shoot for as a goal for your retirement income, right? So we can set up several portfolios and several investment strategies to make sure that you got that amount of cash flow in retirement. Now we need a runway. I mean, you can't tell me you need $100,000 in income in retirement and you're retiring 2 years from now and you don't have anything saved, right? So we need a little time and we need some investments to work with, but it is possible. So, but that's one goal: retiring early. Buying a second home or vacation home is another popular one. Paying for college tuition for kids or grandkids is probably number 3, and then 4 is going back to school or doing something like that. Some traveling, learning in India or learning in Budapest or taking classes wherever seems to be a pretty popular goal here. I think it's because of cabin fever and everybody's been locked up with Corona. So everybody wants to travel right now. I know I do.
Wow. Okay, that is fantastic. Now I got one last question for you.
Okay.
Will you be at the Zoom after party that we having? Are you going to be there?
Yes, I will be there.
All right. Well, hey, everybody else, all your questions, you're going to need to bring them to the after party. If you haven't already got the link in your email address, make sure that you put it into the chat so that we can get you in the database and get that sent over to you so you can join us for the after parties after these wonderful forums, because I got some more questions, but they deep questions and we only put the deep stuff on the Zoom. So peeps out everybody else. But hey, thank you very much, Donnie. That was fantastic. Our last person thank you, man. Appreciate it. The last person who's coming up is going to be Erica Berry. She is a Master Builder Academy board member, owner of Buttercream Naturals. If you haven't seen it, you just want to eat it. But the truth of the matter is there to refresh your body with all natural ways of doing so. Please welcome Erica Berry to close us out. Thank you all, Master Builders.
Thanks, John. Great introduction. And what an excellent forum, as always. I love that if your money's in the bank and a savings, it's just waiting on you to spend it. But like Dejan said, your money is your employees. They're out there working for you. Excellent forum, as always. Hello, everyone. We are so glad you tuned in this morning, and we hope you took some great notes. I know I did. And if you missed anything, hit the share button right now, and you can go back and review this later. So share. Somebody needs to hear this, all right? So how about you joining Master Builders? A Master Builders membership. That Master Builders membership fee is only $100 for adults and $50 for students. When you join Master Builders, you're joining the Master Builders community. It's an opportunity to have your business highlighted on the Master Builders platform, access to all materials presented in the forums, invitation to join our private members-only Facebook page, and an invitation to members-only events, members-only after parties, VIP status at the 2021 Master Builders Academy Hope Forum. You don't want to miss the Hope Forum. So if you want to sign up to be a member of Master Builders Academy, you can send an email to masterbuildersacademy@gmail.com. And now we want to tell you about some new members who joined Master Builders Academy. And we're going to give you a brief showing of who they are. We have Kimberly Florence, Belinda Moore, Amanda Chandler, Pat Williamson, Vincent McClendon, Ronald George, Tom Rushton Jr., Aaron Porter, and Dylan Chandler. Welcome to Master Builders Academy. And just the way we began Master Builders Academy, and we started with prayer, we're going to end in prayer. So now, dear Lord, thank you for each and every person listening to this forum and those who will watch later. Send understanding, wisdom, energy, and ability and strategies to succeed. We pray for our leaders, our city, our state, and our country. Lord, keep us and our families safe and healthy. And until next time, may God bless you. Hey, and don't forget the after party. It's right after this forum. And you know what we're going to do? We're just going to open up the after party for everybody, not just the members today. So we're going to open it up. If you guys will put that Zoom link up there so that everybody can join. I know you've got questions for Mr. Hardison. I know you've got questions for Dejan. I just know you've got questions that you want to get answered. So if you guys put that Zoom link up for the after party so that everybody can join, that would be great. Until next time, see you at the next Master Builders Academy.